Hello everyone, it's Mike again. What do book publishers have in common with semiconductor companies? On the face of it, nothing. But from an accounting standpoint, there are some similarities. Both book publishers and chip manufacturers work with distributors, often maintaining close long-term relationships. In this type of sales model, a company first sells its products to a distributor, which then sells the product to the end user. Sales to distributors are often accompanied by price protection or right of return provisions due to frequent price reductions or technological obsolescence. Accounting for revenue transactions can be tricky when companies like book publishers or electronics manufacturers provide risk mitigation provisions to its distributors because these clauses can affect the amount of revenue ultimately realized from the distributors. This video discusses the revenue recognition rules affecting these sales. Before we examine the accounting treatment of sales made to distributors with price protection or return rights, let's first examine the accounting treatment for sales to distributors without such provisions. Intuitive Surgical sells its surgical systems through both direct sales arrangements and distributors. Its revenue recognition policy for direct sales and sales to distributors follow the 4 criteria detailed in SEC Staff Bulletin 101, which was published in December 1999. Under this guidance, revenue is recognized when 1. Persuasive evidence of an arrangement exists, 2. The product has been delivered, 3. The price is fixed or determinable, and 4. Collection of the related receivable is reasonably assured. Intuitive's revenue recognition policies are described in Note 2 of its financial statements. For systems sold directly to end users, revenue is recognized when acceptance occurs, which is deemed to occur upon customer acknowledgement of delivery or installation, depending on the terms of the arrangement. For systems sold through distributors, revenue is recognized when title and risk of loss is transferred, which generally occurs at the time of shipment. The distributors do not have price protection rights, and the company's system arrangements generally do not allow returns. Both of these methods are reasonable and straightforward. As mentioned before, in the semiconductor industry, sales to distributors are often accompanied by price protection arrangements, volume rebates, and return rights. These provisions make it difficult to satisfy the 3rd criteria, until the distributor later sells the product to the end user. For example, suppose a company sells its product to a distributor with a price protection provision. If the company later reduces its prices to meet competitive pressures, then it must reimburse the price difference to the distributor for its unsold products. Therefore, until the distributor sells the product, the company cannot determine with certainty the amount of the revenue from the sale because the sales price is subject to change. Alternatively, suppose a company sells its product to a distributor with a provision that allows the distributor to return a stipulated percentage of the purchased goods to the company over a period of time. Until the return period expires, the company cannot determine with certainty the amount of revenue from the sale. In many businesses, companies can estimate the amount of returns with reasonable accuracy because return volume is predictable. In the tech industry, however, it is difficult to measure future price adjustments or returns with reasonable accuracy because historically, price adjustments or returns are highly variable. So instead of recognizing revenue at delivery or shipment, a semiconductor company usually recognizes revenue when the distributor ships the product to the final customer and the final price adjustment is known. Now let's move to NVIDIA. NVIDIA sells its products to a variety of customers, including original equipment manufacturers, that is OEMs, original device manufacturers, or ODMs, system buildings, add-in board manufacturers, retailers, and finally, distributors. For sales to distributors with rights of return for which the level of returns cannot be reasonably estimated, NVIDIA's policy is to defer recognition of revenue and the related cost of revenue until the distributors resell the product and, in some cases, when customer return rights lapse. This is an essentially conservative revenue recognition policy that probably understates NVIDIA's actual revenues for a particular period. NVIDIA also offers rebates, which are designed to serve as sales incentives to OEMs in various target markets. Since it is unable, in its own words, to reliably estimate the amount of rebates that will eventually be claimed by the OEMs, NVIDIA defers revenue recognition on sales subject to a rebate until the rebate period ends. When the rebate period ends, NVIDIA will recognize as revenue the portion of the sales subject to rebate that were not rebated to its customers. NVIDIA's policy to defer recognition of revenue until distributors resell the product or after the lapse of the OEM rebate period is an example of the conservatism exception to the accounting principles. As it applies to revenue, the conservatism exception states that companies should delay recognition when there is doubt about its realization. In 2014, however, the FASB issued new guidance on revenue recognition. The new standard requires companies to recognize revenue by applying a 5-step process. First, identify the contract with the customers. 2, identify the performance obligations in the contract. 3, determine the transaction price. 4, allocate the transaction price to the performance obligations in the contract. And 5, recognize revenue as the company satisfies a performance obligation. Public companies must begin using this new revenue recognition process for reporting periods beginning after December 15, 2017. Though this new standard seems innocuous, the third step in the process, determine the transaction price, requires the company to estimate the value of the contract regardless of the difficulty of estimating contingencies. Under this new standard, companies like NVIDIA can no longer defer revenue recognition on sales to distributors until the distributor sells the product to the end user. Instead, beginning in Q1 of 18, NVIDIA must recognize its revenue on sales to distributors at the time of the initial sale. To do this, NVIDIA must forecast, at the time of each sale, the estimated value it will receive from the distributor after netting for expected price protection adjustments, returns, and anything else that could adjust the ultimate revenue received from the sale. When the distributor later sells or returns the product, it will adjust its original revenue estimate upward or downward. Similarly, on sales to OEMs that provide rebates based on volume, NVIDIA can no longer defer revenue recognition on sales subject to rebates until the rebate period ends. Instead, NVIDIA must estimate the expected rebate at the time of the original sale and adjust the revenue accordingly. When it later observes the actual rebate, NVIDIA will adjust revenue upward or downward depending on whether the rebate was higher or lower than expected. Consequently, the new revenue recognition principle is less conservative and more subjective than the old principle. Companies like NVIDIA will recognize revenue sooner than before, suggesting that companies that sell their products to distributors with risk mitigation arrangements will report higher accounting earnings under the new rules. So let's summarize what we learned. First, revenue recognition in Silicon Valley can be quite complex. Sales of products to distributors often include risk mitigation arrangements like price protection, stock rotation rights, rebates, and the like, which affect the amount of revenue ultimately realized from the sales. Now, in the past, companies often delayed the recognition of revenue until distributors sold the product to the end user, which objectively established the amount of the sales revenue. This delay followed the conservatism exception, which allows companies to delay the recognition of revenues when realization is uncertain. The new revenue recognition rules require companies to estimate the expected revenue at the time of the sale to the distributors and adjust for differences between the actual and estimated amounts when the distributor resells the product or the company gets new information. Thanks again for joining me. Please check out more of my videos involving financial reporting topics involving Silicon Valley companies.